Hey everyone, Mortgage Nerd here. Now that mortgage rates are rising, I'm advising a lot of my clients to take out home equity lines of credit. That's an HELOC or HELOC. What this is, it's an open-ended loan. When you take out a regular mortgage and it's a fixed rate mortgage, you only make payments in one direction, right? You make the payment to the lender every month and that's it. That's called a closed-end loan. Well, a home equity line of credit or a HELOC is an open-ended loan. You can pay it down, but you could also receive money. You can go back and forth. Now, typically there's a time period on these that's open-ended, whether it's 5 years or 10 years. And then after that period, it amortizes. That means it turns into a regular loan with principal and interest payments. So you always want to be careful. You want to kind of plan for that 5 or 10 year period, maybe refinance out of it before then. Either way, because it's an open-ended loan, it's always going to be, or almost always going to be, an adjustable rate. Because if you're pulling money out at different times, they want to charge you the interest based on what the interest is at that time. In the beginning of this, I said, because we're in a rising interest rate environment, this is what I'm advising. You might think, why would you put someone in an adjustable rate when we're in a rising interest rate environment? Well, it depends on what you're doing also, because there's home equity loans. A home equity loan is just getting a lump sum, another closed-end type of mortgage. Remember, closed-end mortgage is a fixed rate. An open-ended mortgage is an adjustable rate. So really, it's a matter of what's best for you. But the reason I'm recommending these is it doesn't make sense all the time for someone that might have a rate in the 2s to now turn around and refinance their entire mortgage to pull out $100,000. It doesn't make sense to refinance the $400 that's in the 2s to make it all $500 in the 4s. You want it to be the best blended rate possible, where combining the two rates is optimal for you. I could always run that for you, but ultimately I am referring out a lot of home equity lines of credit now. For a mortgage company like me to offer a home equity line of credit, usually it's a piggyback. That means it's in conjunction with a first mortgage. So I'm offering you a first mortgage, it's a fixed rate, closed-ended loan, and for whatever reason, we need to have a second mortgage behind it, and a home equity line of credit is the best way of doing it. Those are the ones that we offer. We have to close a first mortgage with the second mortgage, and then we can do it for you. If you're going to do a home equity line of credit all in first position, where you're just wiping out what you already have, I've done that before. Or if you're doing it in second position, where you have a first mortgage that maybe we did a while back, and now you're adding the second mortgage to it, that could be done also. Typically, banks and credit unions are better for these. Sometimes you can find them where they pay all your closing costs and you don't have to pay any closing costs. But be careful with that, because they will have a prepayment penalty. If you close it within X amount of time, you're going to have to pay those closing costs. I think that's fair. Others where you pay the closing costs up front. It is what it is. Usually the higher loan to value you go, if you want to go to 90% of your value, you're probably going to have a higher rate. You're probably going to have closing costs to pay. It's when you get to the lower loan to value, 60% or 50%, where there's a little more benefits, lower rates. The way that they offer the rates is usually a prime plus. So they'll set their prime rate plus the margin. If the rate is 0 right now and their margin is 3, then your interest rate is going to be 3%. But if prime goes up 1% this year and then your margin is 3%, then the interest you're going to be charged is 4%. So I'm finding a lot of them in that range, a 3.5 to 5.5% range on home equity lines of credit. Make sure you look at all these different options and see. You could even Google it and just look for something yourself. I'm starting to get together with my local bankers and find out the terms of their lines of credit. So that this way, when I encounter clients that are looking for it, I'm not sending them out there to try to find it on their own. Hopefully I can get some resources for them as well. So that's the Mortgage Nerd on HELOCs. I hope you enjoyed this video. Thanks. Make sure you click the like button, subscribe if you haven't. Give me some comments, give me some questions. I'd be happy to answer them. Mortgage Nerd out.